What's up, guys? It's Graham here, and you better buckle up because the entire car market is fucked. For the first time ever in history, the average price of a new car is about to surpass $50,000.
CEO Jensen Huang is now the 9th richest person in the world, with a fortune valued at $137.4 billion, thanks to a continued surge in the price of Nvidia shares.
We have a deal with China, but the deal with Canada has fallen through. Everybody has an opinion. Financial opinions are like armpits. Everybody's got a couple, and some stink more than others. What I want you to do.
Time is the most valuable asset, and I save it for you. My name's Jason, I'm your host. Welcome to the week in YouTube Finance.
What's up, guys? It's Graham here, and you better buckle up because the entire car market is fucked. For the first time ever in history, the average price of a new car is about to surpass $50,000. Auto loan payments are exceeding $745 a month, and with interest rates near their all-time highs, Americans are now officially beginning to fall behind on their payments. This is why it's so important that we break down exactly why cars have become America's #1 wealth killer, why used car prices are spiking again, and then what the data says is most likely going to happen over the next year, because there are 3 points that you need to be made aware of if you want to save a ton of money. Although before we start, if you appreciate videos like this or even find them helpful, it would mean the world to me if you gave the like button a little gas or subscribed if you haven't done that already. I know it's annoying when I ask for it, but I promise it's going to be a smooth ride. And as a thank you for doing that, I promise to stop making bad car puns. So thanks so much, and also a big thank you to Helium Mobile for sponsoring this video, but more on that later. Alright, so first of all, we gotta talk about the boogeyman for anybody who owns a vehicle, and that would be depreciation. Like, here's the thing, for the longest time, when you think about car prices, you'd imagine a chart like this. In a normal market, a new car is expected to lose anywhere from 9 to 18% the moment you drive it off the lot. And then from there, prices continue to fall by an additional 10 to 20% a year until after 5 years of ownership, you're left with about 40% of the price that you paid. However, these last few years have completely messed that up. Because of a shortage of auto manufacturing, a limited supply of parts, record low interest rates, and a surge of demand, used car prices began to defy the laws of gravity by going up in price. For instance, in 2021, used car prices were 40% higher than the year prior, meaning back then you could literally go and buy a car, drive it around for free, and then sell it a few years later for a massive profit. Not to mention, throughout 2022, it wasn't unusual for buyers to pay over sticker price just to get the car from the dealership. And at the height of the shortage, the average vehicle was priced 9.9% above MSRP, all thanks to high demand and limited supply. Yet, despite nearly every other pandemic shortage eventually coming back down to reality, car prices never really fell that much. Like, as of now, new cars are still $12,000 more expensive than they were a few years ago. The typical family would have to spend 70 to 80% of their entire year's pay just to buy a vehicle at today's prices, which is double from what it used to be in 1990. And all of this simply means that car prices are outpacing incomes, more buyers than ever have payments that exceed $1,000 a month, and we have a new category that's absolutely out of control, and that would be skyrocketing debt. See, when buyers purchase a car, the vast majority of them are financed. In fact, 85% of new car purchases are bought with debt, along with 55% of used car purchases. And what makes this so unique is that, unlike real estate, auto loans are not subject to strict underwriting requirements, allowing pretty much anyone to get financed for a new vehicle if they really want to drive off in a new car. You know, I mentioned this before, but the situation got so bad that in late 2021, Jalopnik ran a story about just how easy it was to get approved for a loan, and just how predatory lenders have become, calling it a true wild, wild west and a poorly regulated wasteland. In this case, their investigation found that borrowers in every credit score category were given loans with APRs that ranged from 0% to more than 25%. Or in other words, buyers with great credit scores were being funneled into high interest rate loans with interest rates that were more than double the average, since they were just desperate to get into a new car. On top of that, 25 to 50% of loans were given to customers who might not have been able to afford them. And to make matters worse, lenders rarely verified income and employment to borrowers to confirm they had the sufficient income to repay the loan. Of the loans Consumer Reports looked at, the these verifications happened just 4% of the time. This has now resulted in 5% of all auto loans in the United States being more than 90 days behind on their payments. Subprime loans have hit a record high delinquency rate, and 39% of all buyers are underwater on their purchase, meaning they owe more on the car than what the car is actually worth. How is this allowed to happen? Well, I'll let you in on a little secret. Contrary to popular belief, an Iowa law review found that over the last 10 years, car dealerships have begun making more profits from the financing of cars rather than from the cars themselves, meaning they have a direct financial interest in you taking out as big of a loan as you possibly can, because that's actually how they make their money. Not from selling cars. Like, to give you an idea just how big this problem has become, US auto loan balances have increased to $1.64 trillion, which is now the second highest debt category after mortgages. In fact, people have taken out so much money just to buy a car that auto debt has increased 70% in the last decade. So to compensate for that, people are forced to take out longer loans just to stretch out their payment to a manageable level. Or in other words, instead of taking out a $30,000 loan for 4 years pre-pandemic, which equates to $690 a month, they're now taking out a $50,000 loan for 8 years. So this way, their monthly payment stays relatively the same, even though behind the scenes, this results in more debt, more interest, and less equity. However, we now have another aspect that could completely flip the car market from where we are today. And this is something you gotta pay close attention to. Although before we go into that, speaking of prices, it's not just your imagination. Thank you so much, and now let's get back to the video. Alright, now in terms of the car market, there are two main points that you need to be made aware of, especially if you're gonna be buying or selling in the next year, with the first being rising inventory. See, here's the thing. Car inventory is often measured in what's called days supply, which calculates how many days it would take to sell off current inventory at the current sales rate. At the worst of the shortage, most brands were under 30 days, with some of the more popular models literally selling the moment they hit the lot. But today we're back to about 70 days worth of supply, which reflects a perfectly balanced and normal market. But not all brands are created equal. For example, Dodge currently sits at 111 days worth of supply. Ford has 99, and Lincoln has 127 days, reflecting a lot of unsold inventory and plenty of discounts. On the other hand, Toyota, Honda, and Subaru are still in high demand, with certain models under 40 days worth of supply, so the prices throughout these automakers are staying pretty firm. This has resulted in some very clear winners and losers throughout the auto industry, and if you're wondering where prices are rising or falling the most, you're going to want to hear this. Surprisingly, the largest increase was seen throughout the BMW 4 Series, up nearly 20% year over year in the used car market. Why? Well, it's theorized that this is the result of limited supply combined with high demand for luxury cars in that price point. This is also the same thing being found with the Infiniti QX60, which is up 16.5% from a year ago, and the Porsche 718, which is up 15.7%. On the other hand, the largest decrease was from none other than Tesla, with prices falling double digits over the last year and depreciating 70 times faster than a Chevy. Now, a lot of this is likely due to the fact that Elon Musk has become pretty polarizing lately. Electric vehicle tech is changing so quickly that some buyers are just waiting for the latest innovations, and a lot of people who wanted an EV have already bought one. But if you're in the market for a used EV right now, I gotta admit, it's pretty tempting to pick up a good deal for a fraction of the price new. And if you bought a Tesla between 2021 and 3 for full price, well, you probably lost about 50 to 70% value in the last 24 months, unfortunately. Although keep in mind, this is only one component of the overall market, and even though inventory is increasing, there is another curveball coming pretty soon, and that would be tariffs. That's right, in an unusual turn of events, automakers are preparing for a 25% tariff on imported vehicles and parts, meaning once again, prices could go higher. For instance, analysts estimate the tariffs will add around $3,000 to the cost of US-built cars and a whopping $6,000 to vehicles made in Mexico or Canada. Not to mention, Porsche is holding on to extra inventory, not sure how much to mark up prices to compensate for the extra cost. Now, if you're wondering why on earth prices of US-built cars like Ford would see a price increase, keep in mind most vehicle manufacturers cannot feasibly source all of their parts from the United States, and it's common practice to import various materials from around the world. world. This is why no matter what car you buy, there will be an impact to its price if tariffs remain in effect. On top of that, there's also talk that automakers might actually just stop making lower-priced cars altogether if they just aren't profitable anymore. And if certain parts get too expensive or hard to find, we could see even more production delays. So even though the car market was finally starting to cool off and head back to normal, because of tariffs, we could see prices starting to go back up again, with one estimate suggesting that each car might cost $2,000 more than it did previously. But in terms of where prices are realistically headed over the next year and what you could do to save yourself as much money as possible, here's what you came for. Overall, it seems like most experts believe that used car prices will continue to see a gradual downtrend over the next year, especially if defaults increase and inventories stay high. Some forecasts even suggest that new car prices could fall a few percent as competition heats up. But there's also a chance that prolonged tariffs erase this decrease entirely and actually cause new cars to get more expensive, leading to more demand for used cars. For example, we're already starting to see this throughout older vehicles, and as CarEdge pointed out, retail customers that want to purchase a car sub $20,000 are forced to look at older used vehicles because the new ones have increased in value beyond their budget. That's why if you're in the market for a car, I highly recommend you take your time, you're not afraid to negotiate, and most importantly, if you're getting a loan, shop the loan around to find the best possible deal. That way you're not going to be reliant on the dealership who's going to charge you whatever they could get away with. Typically, I've found that credit unions offer the best deal, and there are plenty of ways that you could save a ton of money just by doing this yourself ahead of time. Separate from that, in terms of what you could afford, the general rule of thumb is what's called the 24-10 rule, which suggests you make a 20% down payment on a 4-year loan where you spend no more than 10% of your monthly income on transportation. If you could follow that, you're going to be in a great position financially, even though in reality, the opposite of that happens. Unfortunately, the average down payment is just 11.7% on a 72-month loan with a car that's kept for just 71.4 months. So basically, people haven't even finished making their payments before they roll it into a new loan to start the process over again with negative equity. That needs to stop. Ideally, for most people, they would be best off just sticking with a good, used, reliable car that they could comfortably afford, that they could pay off as fast as possible, and then keep until it doesn't run anymore. Or if you're thinking of selling your car because you could no longer afford the payments, now is a pretty good time still to sell and move on to something that's going to cost you a lot less, especially if it's an EV. Of course, let me know what you think of all of this down below in the comments. I will do my best to read and reply to as many of you as I can, and if you want to be kept up to date on the car market, I'd highly recommend CarEdge, who I'll also link to down below in the description. Thanks so much for watching, and until next time.
Thank you, Graham. So what do you think? Are you in the market to buy a new car, used car? Are you going to go brave those interest rates and stuff like that? Let me know. Thank you so much.
Nvidia CEO Jensen Huang is now the 9th richest person in the world, with a fortune valued at $137.4 billion, thanks to a continued surge in the price of Nvidia shares. Huang's 3% stake in Nvidia, totaling more than 859 million shares, has increased by about $11.6 billion over the last 5 trading sessions. As of around 1:10 p.m. Eastern Time Friday, Nvidia shares rose by more than 1.6% to over $157.60 a share. Since the stock opened tracking on Monday at $142.50, there's been an increase of more than 10%. Wedbush securities analyst suggested in a note Friday that Nvidia and Microsoft will each hit a $4 trillion market cap this summer and $5 trillion over the next 18 months, as he referred to the companies as the, quote, poster children, end quote, of AI. Nvidia reported higher than expected earnings and revenue through its first quarter in May, as Huang told investors the global demand for Nvidia's AI infrastructure was incredibly strong. Nvidia ranks ahead of Microsoft as the world's largest firm with a $3.83 trillion valuation as of Friday. The latest winning streak for Nvidia follows concerns the company would be hit by President Donald Trump's tariffs and export controls on China. The US imposed export restrictions on Nvidia's H20 AI chips to China earlier this year. Huang said these restrictions would lock Nvidia out of a $50 billion Chinese market and argued the export changes cut sales without a grace period. Nvidia's stock has also increased by 81.7% since hitting a 52-week low of $86.62 on April 7th, though shares are up just under 14% on the year. Loop Capital analysts raised their price target for Nvidia's stock to $250 from $175 as they believed Nvidia could benefit from stronger than anticipated demand for its products. According to FactSet, this is above the average $173 forecast among Wall Street analysts. For more on this story, check out the article at the link in the description.
Thank you, Forbes. So have you put some money behind Nvidia? I did. I think I threw about $30, big baller type of stuff. How about you? What kind of stuff are you investing in these days? Share the wealth. Well, share the information.
President Trump says that the trade war with China is officially over because China has signed a trade deal and China agrees. They said, quote, both sides have confirmed further details on this framework, and this good news got investors so excited that we saw the stock market break new record highs because investors are hoping that this new trade deal is going to help the economy boom and it's going to help the stock market boom even more. But let's dig a little bit deeper to understand what this new trade deal is, because we've seen a lot of changes. Before President Trump entered the White House, the United States did have tariffs on Chinese goods. It was at a baseline of 3%. China also had tariffs on United States goods. They had a baseline tariff of around 8%. And this is what President Trump said was unfair. China is taxing us more than we are taxing them. That was when President Trump entered the White House and raised tariffs on many countries, including China. And President Trump jacked up tariffs on China all the way to 145%. And China reciprocated, raising tariffs on United States goods up to 125%, which put business with China on hold. Because if you're a business and now you have to pay 145% more, you're gonna have to sell your products for a whole lot more. And this was painful for our economy because China is the third largest trading partner with the United States after Mexico, after Canada. Well, it looks like we finally have a deal with these tariffs. This is what Treasury Secretary Scott Bessent said. The new United States tariffs on Chinese imports will start at 30%, and China tariffs on United States imports will be around 10%, which means it's about 10 times higher than what it was pre-President Trump, because we were putting a 3% tariff on Chinese goods baseline before President Trump. Now it's around 30%, and the Chinese tariffs on the United States are slightly higher than what they were pre-Trump. And this is why investors are so excited, because they're hoping that we're going to see more trade deals, that this means more business is going to be coming into the United States, that businesses will feel more comfortable finally investing and spending money again to boost the economy, boost the job market, and boost the stock market. But we will ultimately see what happens. But the stock market is booming. However, Canada doesn't agree. President Trump has canceled trade negotiations with China. He said he's, quote, terminating all trade discussions with Canada effective immediately because Canada imposed something called the Digital Services Tax that would essentially be taxing technology from the United States. And President Trump does not like that. And he has said that he's going to be announcing new tariffs on Canada coming within the next 7 days. So let's see what ultimately happens with that. We have a deal with China, but the deal with Canada has fallen through. Chances are something's going to be renegotiated, but that's where we are right now. Now, I want to dig a little bit deeper into the report, saying that prices of things could be rising in the United States starting soon. But before I do that, I've been getting a lot of questions recently about how do you actually invest your money through this type of volatility when markets are breaking new record highs. There's concerns about the economy, and there's a few things I want you to understand because I get this question a lot. You can do it yourself. You can also work with a financial advisor. It's not bad to work with a financial advisor. For some people, it's going to make things a lot easier. For others of you, you're going to want to do it yourself. There's no one size fits all. Personal finance is personal, and you want to know what is your right strategy. But if you do want to work with a financial advisor, make sure you know what your goals are, because it's kind of like a doctor. You want to get multiple opinions, and you want to make sure that the doctor is doing something that's in alignment with what you want. So if you are going to be working with a financial advisor, there's nothing wrong with that, but make sure you know what your goals are and you're working with a good financial advisor. If you're going to be doing it yourself, you have to know your strategy and stick with your strategy, because when things go crazy, you want to make sure you know how you can make your way through all the craziness. Now, for those of you that are looking for a financial advisor, again, I've partnered with a company called MoneyPick. And with that, let's talk about why people are saying that we could be seeing the prices of things rise in the near future. And the reason why is because this is from CNBC. More sticker prices are going to rise due to tariffs and inventory is heading down. Meaning, although tariffs have been in existence, we haven't seen the price hikes yet, and we're also seeing the inventory of goods around the country falling. And the reason why people are saying this is because we have some companies that are issuing warnings, like Nike. Nike just issued a warning saying that you'll be seeing higher prices soon because of tariffs. And the reason why Nike is saying this is because they've had this inventory of goods that they've been selling that wasn't impacted by tariffs. That's why even though there are tariffs today, you haven't seen a big run up in prices yet because they had that inventory. Well, after the tariffs came into place, we saw inventory go down and costs go up. And now that they're running through the original inventory, the new tariff impacted inventory is going to be sold soon. And that tariff impacted inventory is going to be sold at a higher price, while there's also going to be a lower supply of that inventory. And if tariffs continue, that's going to continue to keep the prices of things high. This is what Nike is saying. And that's why some people took real interest in the most recent inflation report that we got, which said that inflation came in slightly higher than expected, saying, hey, tariffs are there, but the real impacts of tariffs are yet to come, and you should be expecting higher inflation come Q3 2025. So we'll see what ultimately will happen, but it looks like the previous inventory of goods pre-tariffs are starting to be run out. More businesses are saying, hey, expect the prices of things to start going up in the next few months. And we'll see if they actually stay high or not, because you have some economists saying if we do see the prices of things like, say, shoes go up because of these tariffs, it's going to be a transitory rise in inflation. And once the tariffs are negotiated and they go away, the prices of things will fall. Now, for anybody who has not been living under a rock, you know that anytime you hear transitory inflation, you kind of buckle up a little bit, because we saw what happened last time we heard transitory inflation. I don't know what's ultimately going to happen, but it seems like if tariffs are around for a while, they could cause the prices of things to go up, especially if businesses cannot absorb that cost. But the real interesting thing that you want to pay attention to here is how much are the prices of things actually going to go up? Because we have a lot of variances, and that's the part everybody's guessing. We don't know. Are they going to go up 5%, 8%, 20%, in which things? And are people going to see their incomes rise during this time, or are we going to see the economy slow down? Because we're in a very interesting stage in our economy, where over the last 5 years, inflation has been around 24%, a little bit higher. Median incomes have gone up around 20%. Which means over the last 5 years, the average person's income didn't keep up with inflation. Nothing groundbreaking there. But the question now becomes, what's going to happen over the next 12 months, 24 months, or 36 months? Are we going to see incomes continue to grow? Or are we going to see the economy slow down more? Because we have one group of people that are saying tariffs are going to hurt the economy. We have another group of people that are saying tariffs are going to strengthen the economy, that we're going to have more jobs in the United States. We're going to have more manufacturing in the United States. Which one is it ultimately going to be? Well, only time will tell. Everybody has an opinion. Financial opinions are like armpits. Everybody's got a couple, and some stink more than others. What I want you to do is not try to guess what's going to happen. Everybody can do that. I want you to be able to profit no matter what's happening. And the way you do that is by understanding how do you build wealth in this economic system. Now, if you've been subscribed to this channel, you know that the way you build wealth is by investing your money. And the reason why I say that is because stocks love inflation. It's a weird thing to say, but it's reality, because if we take a look at 2020 to 2022, when we had that high period of inflation, stocks were loving it. And the reason why stocks were loving it is because when you spend more dollars at businesses, if you spend more money at Chipotle, you give more money to Walmart, you spend more at Amazon, who does that benefit? Yeah, I mean, it can benefit the employees who might get a raise, but what we've seen is that people's raises generally don't keep up with inflation. The real beneficiary are the people that are generating the profits. And who's getting the profits at Amazon or Chipotle It's the owners. Who are the owners? It's the investors. This is why you have to understand the game. The way you win in this economic system is by being a long-term investor, period. And you have to be willing to withstand the craziness. Chances are we're gonna see craziness coming. I mean, the next wave of tariff announcements is supposed to be July 9th. I say supposed to be because very recently the White House said that maybe July 9th doesn't need to be a very rigid deadline. I don't know what's gonna happen, but originally the next announcement was gonna be July 9th. And we're gonna get more information about tariffs. And we know anytime we get new tariff announcements, it can move the stock market up or down. We just got the news about China. This helped the stock market break new record highs. If the deal went the other way, well, you bet the markets will probably be going down. I don't know what's gonna happen on July 9th. We could get good news, we can get bad news, but in any case, it creates opportunity. When markets went down in February on the announcement of tariffs, in March on the announcement of tariffs, in April on the announcement of tariffs, it created buying opportunity every single time if you knew what you were doing, if you had a strategy. Now, if you're sitting there panicking, you're selling stocks, you're the one that's selling stocks to somebody else who's buying them for a big discount. But this is where everybody says, what if we enter a recession? Well, we might enter a recession. We could see the stock market fall by 20, 30, 40, 50%, maybe 60%, depending on how bad it is. Then what? We know over the long term, markets go up. And so when you have this short-term mindset of what's gonna happen in the next 6 months or the next 3 years, yeah, it's very stressful to invest your money. But when you say, I want to invest for the next 10 years, the next 20 years, now it's not as stressful because what happens over the next few years doesn't really matter. We know that recessions are gonna happen. We know we're gonna see some really severe recessions. But if you have enough time, you can withstand those recessions and use those downturns as an opportunity to buy even more. And that's the way that I want you to think. I want you to be finding the opportunity as opposed to being the person that's just panicking. Now again, if you want some additional resources, my team at Briefs Media publishes a free daily report called Market Briefs, where we break down what's happening in the economy, housing, stocks, crypto, and global markets into a fun, ready, and easy to read newsletter. It's read by hundreds of thousands of investors every morning. And when you join Market Briefs, you'll also get my investing masterclass as a complimentary bonus, where I'll walk you through how you can get started as an investor and find hidden investment opportunities before anybody else. It's all completely free. So if you want to join Market Briefs, I have the link for you down in the description below. And for those of you, because I get this request a lot, who want more, you want more research on which stocks should you be considering investing in, where is money moving, we have a higher tier product called Briefs Pro, where our team of analysts are publishing a report breaking down where money is moving, where you can find opportunities. That's something you can check out as well if that's something you're interested in. If not, no big deal. Start with Market Briefs. It's completely free. And with that, I will see you on YouTube on Monday.
Well, thank you so much for being here. This is the 26th week in a row that I've done this, so pat myself on the back. The goal is 100. I made it half a year so far, is that right? 26 weeks. Wow. Anyway, thank you so much for being here. Do me a favor, throw me a like if you made it this far. Hopefully I've earned your subscription. I would love to see you next week. I'll catch you on Sunday. Take care. See you soon.